Every single byte of data stored high up in the cloud actually exists down here, inside a loud, hot, industrial warehouse. Every time you run an AI query, automate a workflow, or stream a video over a 5G network, you trigger a physical server. Because government data localization rules require Indian data to remain within the country, tech giants are building those servers locally at an aggressive pace. This chart shows the scale of the transition. India currently operates at about 1.5 gigawatts of data center capacity. By 2035, projections show that number reaching 14 gigawatts. The y-axis measures the primary constraint of this expansion: raw, physical electrical power. Profiting from this growth requires investing in physical land, concrete, and energy generation. This is heavy industry, distinct from the software trends of previous decades. This table outlines the shift from the 2000s software boom to the 2020s infrastructure boom. 20 years ago, IT scaled with high margins and low overhead. Today, building one data center requires a multi-billion-dollar commitment before the first rupee of profit is realized. Because of that high upfront cost, finding a pure-play, publicly traded AI or data center stock on the open market is difficult. The components required to build out that 14-gigawatt network, commercial real estate, high-voltage grids, thermal cooling systems, and underground fiber optic lines, are distributed across entirely separate, massive industries. This leaves you with a specific problem. How do you capture the upside of a decade-long expansion without absorbing the risks of construction delays and physical supply chain bottlenecks? Surviving a capital-intensive cycle like this requires looking past single stocks. You must orchestrate a thematic, multi-sector basket of companies that each handle a different piece of the infrastructure. This quadrant chart evaluates the 4 primary subsectors. The x-axis tracks time to profitability. The y-axis maps capital risk. We plot power and energy in the upper right. It's a high-risk, long-gestation sector, but the foundational enabler of the AI ecosystem. Adding 12.5 gigawatts of server capacity requires a constant draw of electricity. Investing in utilities captures that unavoidable baseline demand. The trade-off is regulation. Utility exposure ties you to government pricing controls. Next, we map cooling and engineering into the high-risk, medium gestation quadrant. AI servers run hot, requiring specialized hardware. Companies building HVAC systems and thermal management hardware command strong margins because their technology is a non-negotiable requirement for a facility to function. However, investors in this sector face exposure to technological obsolescence. In the infrastructure space, obsolescence means your hardware becomes irrelevant because the underlying server architecture evolves to no longer need it. If chipmakers achieve a breakthrough in processing efficiency, servers run cooler naturally. That innovation instantly reduces the demand for current legacy cooling systems. Power and cooling offer the most direct exposure to structural growth, but you must accept regulatory and technological risks in return. Turning to the defensive side of the equation, we map specialized real estate and REITs into the low-risk, long-gestation quadrant. Data centers require highly specialized, massive physical footprints. The REITs owning these facilities generate predictable, long-term rental yields backed by tenants like Google and Amazon, who secure long-term leases. But predictability has limits. Real estate valuations are sensitive to interest rates. Finally, we map telecom and fiber into the low-risk, short-gestation quadrant. These companies own the established physical arteries moving data across the country. Telecoms operate as entrenched duopolies. They possess deep moat infrastructure networks and millions of existing customers. The drawback is revenue dilution. Money these companies make from leasing data center bandwidth is mixed into their much larger consumer mobile and broadband businesses. Because data infrastructure represents only a fraction of their total income, a telecom giant is a poor choice for concentrated exposure to AI. Instead, telecom acts as a defensive ballast, providing steady cash flow. Looking at the evaluation map, we see how the 4 sectors balance each other across risk levels and time horizons. No single quadrant provides risk-free exposure to the data boom. Blending these sectors is necessary to protect your downside. Reaching that 14-gigawatt target by 2035 will be a grueling process. The macroeconomic headwinds are substantial. This line graph maps out the reality of a multi-billion-dollar capital cycle. Notice the sharp early spike in CapEx spending, peaking between 2025 and 2028. The curve for realized revenue only begins to rise years after that initial cash is spent. That 10-year gap guarantees volatility. Companies will face regulatory delays, zoning disputes, and prolonged land acquisition battles. Even if the land is secured, localized power shortages will act as a primary headwind, threatening to stall these growth projections. Because these delays are a structural part of infrastructure, you must match your sector choices to your personal financial timeline. This decision tree provides a matrix for building a customized thematic basket based on your primary investment goal. For a lower risk tolerance, we follow the steady income path, routing capital into REITs and telecoms. By weighting your basket toward existing real estate and entrenched networks, conservative profiles bypass the risks of the initial construction phase. For a long time horizon, we follow the structural growth path, which routes into the power and cooling sectors. Aggressive profiles target the primary physical bottlenecks. If you own the electricity and thermal engineering required to keep the servers running, you capture the pricing power in the ecosystem. Regardless of the path, it is critical to maintain at least a minor defensive allocation in the opposite branch. Growth investors need telecom for stability, and income investors need power exposure as a hedge. Capturing a piece of this 10 lakh crow market relies on orchestrating a balanced basket of the physical infrastructure that makes the digital world possible.